as a journalist, you're kind of a professional skeptic. And I think when it comes to AI, the gut reaction I have sometimes is, okay, just prove it. I think that when it comes to actual applications, I think that to kind of view how it can help with my own job is that it can help with the back office tasks and help simplify and streamline those things. But what ultimately makes my job useful, or what makes advisor useful, is the power of the relationships that you build, whether it's with a client or with a source. And I don't think that AI can necessarily build trust, but I think that, yeah, maybe you can use AI to generate some sort of mass prospecting campaign. It can generate a potential prospect list for you. Maybe it can do that, or it can help with some of the trading and rebalancing. But it's very difficult for me to see AI replace what I think is the ultimate job of a financial advisor, is to have the emotional intelligence to protect a smart person from their own worst instincts and to help them. I don't think AI can necessarily replace the power of that human element.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
My co-host and I, Jim Warden, our CIO, are very happy and pleased to invite a few of my personal friends in the industry of journalism and financial media. Ian Wenik, the editor for Citywire. I know a lot of financial advisors, owners of RIA firms, broker-dealer folks know who Ian is. He's at a lot of conferences, including the ones that they host themselves. In fact, he's right now in Miami at the Future Proof Citywide conference, right? Which he just said was very, very windy.
That is correct. And I feel like now, with such a great intro, I've got a lot of pressure to live up to that billing. So yes, I am at Future Proof Miami, and I'm looking forward to being here today.
Thanks, Ian. And Toby, if it's okay if I call you Toby, because I feel like we're friends, Toby. Toby Salinger is the chief correspondent for Financial Planning magazine that all of us read and watch regularly for the new articles and things that come out. And Toby and I have been good friends for a long time as well. So these two young men have been friends of mine and people that I've gone back and forth with in terms of the media. As far as a lot of print stuff regarding our industry for, I don't know, probably 5 or 6 or 7 or 8 years in maybe Ian's case. Ian likes to come out to Vegas a lot. We're going to get into hobbies later, but he has a reason. He has some family and some other reasons that he likes to come visit Las Vegas for. But I thought it would be phenomenal to have a few people that cover our business, the financial advising business, and the infrastructure of that business, and all the different pieces of that business. And they talk about a lot of different things regarding issues that are important to financial advisors and to actually investors, right, into financial planning clients all the time. And so, especially on Toby's side.
Well, I'm nervous as well, because I'm usually asking you the questions when we talk.
Well,
you're turning the
flip the script once in a while. So. You guys are
always healthy.
Yeah, this is unique in the sense that you're the first guest that we've had on our podcast that's not some sort of a chief economist or chief market strategist or CEO of a big firm, something like that. And so we're very happy to have you guys on. I think financial advisors can learn a lot about our industry and how the media and financial advising industry work together. I've been a factor of that. So is Jim. We do a lot of media interviews, both TV and print, all the time. So does Tally Leger, our chief market strategist, who's typically a host on this show, but traveling today. So we've got a myriad of different topics that we wanted to cover, and some things that maybe they might want to cover too. But I wanted to ask Ian, because you talk about this a lot, Ian, in your pieces. And if you guys don't know Ian, his passion in life is to break the breaking story of the financial world. And that's seriously his passion, and I'm sure that is for Toby too. But he's really into it. And one of the things I know that he's been talking about a lot for the last several years, at least, is all of the M&A that's been going on. He's always breaking the news on who's buying who and what's going on. And so I think financial advisors would love to know, especially a lot of independent advisors just don't pay a lot of attention to that stuff. Frankly, even as an RIA owner, I didn't really pay a lot of attention to it for a number of years just because I didn't want to have to be involved in it. And now I am to a degree soon enough. But Ian, talk about that. What's the landscape of M&A? How's it impacted our industry? We'll talk about PE firms later on, but it's yours.
Yeah, I mean, I think that what we've seen, and it's kind of a trend we've seen play out the last, I think, 7, maybe 10 plus years in this industry, is this is all downstream of just the broader professionalization of this industry and the evolution of these businesses from being personality-driven businesses based around the charisma of a founder who hung their name on the door to a business that has dozens, if not hundreds of employees, billions of assets, outside stakeholders. And I just think that private equity has gotten wise to this business, and I'll get into a little bit maybe later on about why PE loves this industry so much. But PE views this as a very attractive investment, and if you want to provide a good return to a PE firm or an outside investor, you have to professionalize and standardize. And so that's why we've seen a lot of this stuff going on. It's either that or you're a firm led by one of those charismatic founders, and you don't have a way to extricate yourself from the business once you're near retirement age. And so if you can't afford an internal succession, you find somebody to sell to. And I think as we've seen the last couple of years, there is no shortage of buyers of all shapes, stripes, and sizes and business models.
Yeah, I feel like we can talk about this subject for a whole hour, actually, for the whole podcast if we wanted to. It seems like there's a lot of reasons, as you said, on why there's so much M&A going on. Obviously, private equity firms have seen this space as an area where they can create a nice return for their investors. Toby, do you have anything to add to that?
Well, yes. I mean, the competitive dynamics are certainly adding to it as well. I see the succession all the time. I see the private equity investment, but I also see a lot of advisors who are looking for that scale and that technology that they may not be able to get on their own. They see the value in going into a larger organization in some way, shape, or form. Maybe it doesn't mean selling the entire advisory practice. Maybe it means changing RIAs. Maybe it means joining a different enterprise. It could mean all sorts of different things. And there are more and more options out there for advisors pitching their services to the advisors all the time. So it has been interesting. Ian mentioned the last decade or so. And as friendly competitors to Citywire RIA, we also admire their scoops all the time as well. And we add to it ourselves too at financial planning. But what we hear from advisors is, hey, I got into this business to talk to clients and to be with my clients. I love my clients. I love the time I get to spend with my clients. I don't feel like doing payroll. I don't want to do these other operational things all the time that it takes to run a business. And so as entrepreneurial as advisors are, sometimes they want a little bit more back office support for whatever reason. So that's, I think, one of the drivers as well.
Yeah, it's interesting because I've seen that too. I've spoken to financial advisors that are in their 40s who have sold their practices. And obviously they're not going to retire yet, most of them. And that's not what they're looking for. They're looking for maybe to plug into somewhere that can help them with their next phase of growth or making their business better for their clients, right? And obviously succession's on the minds of the older advisors, where I think demographics have a lot to do with it. As we hear that the typical financial advisors in their late 50s, or maybe even older. And so we have this probably another decade or so, I think, of M&A opportunities. And because of demographics, because of the demand, I'm sure now, as we all know, as advisors are getting called a lot. The firms that you're with may also be purchasing advisors and things like that. And so It's interesting, and I'm fascinated to know how this is all going to end, because I've read articles even 5 years ago, right, that there are going to be less firms out there. That seems like what may happen. And I want to ask Ian about that. Before we go there, today is March 17th, and it's St. Patrick's Day. And I see a little bit of green behind in a picture for Toby, but I don't see any green on, man. Where's your green?
Yeah. I mean, if there's someone around, I'd get pinched, I think.
That's the Miami right? Hotel room, so no green for him. Jim says his blue shirt is green.
It's a little bit aqua color, but like I figure Ian is in Miami. This is my best Miami Vice look.
There you go. And then you see
I got some Gatorade. It's green.
See a lot of green in my background. I've got a green cup. I don't have anything green on it, I don't think, but I've got a green cup thingy. And anyway, I got more green than you guys. Well, Ian, what do you think about that?
I'm not able to get to Miami, but we had plenty of observance of St. Patrick's Day over the weekend here in Chicago. I can assure you. So.
I attended something on Friday. It was like a tennis thing, but it was a mixer, and there was a lot of green there. But
so Toby, do you guys still make the river green in Chicago? Yes. You do, right? I mean, that's a big thing.
It is huge, and depending on where you sit, it's a great reason to either run downtown to see it or avoid downtown at all costs. There are huge crowds. It's really cool. Although the rivers are not green anymore today already because it snowed yesterday. So
wow,
that took away the green from the river, unfortunately.
I didn't know that, Jim. That's interesting.
Huh. Oh yeah, that's a big deal in Chicago. They always make it green. And I don't know if people swim in that when it's green. I don't know how safe the water is. But
I wouldn't swim in it. I saw one person who might have had some other influences at hand jumped from a bridge into the water, but that didn't seem like an advisable idea.
I'm sure in Boston, the party's going to continue on tonight and today, probably even a half day today, maybe. Ian, so tell me about what your view is on consolidation. A lot of people say there's going to be just a few handful of firms left standing, outside of the big major firms out there. And now somebody just told me that Apollo is getting in the game. They're one of the larger PE firms that everybody knows, and they're going to start buying RIAs. What do you think is going to happen to the industry from a consolidation standpoint, and what's it going to look like 10 years from now?
Well, it's interesting. I mean, I think that the main thing that I'm wondering about, we're going to see whether we're going to see it 10 years from now, 5 years from now, is there going to be someone who is the first mover to try to go public? Because I think we talk about this consolidation, all these private equity firms, and that's great and all. The valuations have made a lot of people very, very, very rich. But I think the unspoken thing that people don't really want to talk about is, so what is the actual end state? Because yes, there are these firms that are backed by companies like KKR and Carlyle Group. But those companies generally make a public exit, and there is no perfect public comp out there right now. I mean, LPL kind of, but that's not a pure play RIA business. So are we going to see someone make a public move is the main question I have. And I think that you'll start to see some of these other sponsor-backed firms that have been through 2 or 3 rounds of private equity backing. Their move may ultimately be to combine in a strategic merger, and that'll give the PE player an exit and create a hyperscaled player. And so I think we are directionally trending towards a universe of a couple of mega firms, a couple dozen. But I think the question is what those ultimate monetization events look like is kind of an open question.
Well, it seems as if, as Toby, you were saying, one of the results, in my opinion, is that the end user, the investor, financial planning client experience, might become a little bit more elevated, I think, because these firms have more capital to invest into systems and processes, technology, resources, all-encompassing business models when it comes to wealth management. So you've got the tax, the trust and estates consulting in-house. It looks like more of what the wealthiest clients experience in a family office type environment is coming down to people that don't have as much wealth. Do you guys agree with that? Is that what you think? Do you see that out there with some of the firms that are already, very big now?
Yes, I think it's a huge part of their value proposition to advisors to say, hey, I can help you deliver all these other types of client services, and I can help you get a better deal through our economies of scale with the outside service providers. That holds a lot of appeal to advisors who can A, get tasks off their plate, and B, maybe deliver an even better product at a more competitive price to their base of clients. So I think it's definitely a key part of the recruiting pitch for these aggregators who continue to consolidate the industry year after year. On the other hand, you also see new RIAs continue to start up. We see record numbers of RIAs each year. Even if maybe not all of them are retail wealth management RIAs, the majority are. And we still haven't seen that abate yet, even with all of the consolidation. It's one of the reasons why most people expect this level of deal making to continue. I think one of the most important things that many experts have told me over the years is for advisors, slow down. Take your time with these decisions. They are a life-changing decision in your business's life. So you want to make sure that you're on the same page about the deal structure, what happens after the deal, where is the succession going to be for clients, for the business, and make sure that that vision is on the same path as what you had in mind. Because, one of the other sides of the whole consolidation thing is sometimes there's a bit of remorse. And at that point, you have sold your business, then you've sold it to someone else. A lot of advisors got out of the wirehouses so they could own their own businesses. And so there are people worried just about the service model, the fiduciary duty, no small thing there, and how they have structured their businesses. As many calls as they're probably getting, as many calls as I wish I was getting, where I had something on the value of a profitable wealth management business attached to my name. I just hope that all the advisors take their time, retain professional services as needed, with investment bankers, with consultants, what have you, to make the right decision for themselves, their teams, their clients, their families, everyone, because it is such a huge decision. And it will be interesting to see about someone going public or not at some point. I would personally like that as a journalist. I'm often wondering, well, how much did you pay for this firm? I realize the terms were not disclosed, but don't you want to just tell me anyway? And they never do. But if they're public, they're going to have to start disclosing some of that information. And that might be, that's one of the factors that might make it more difficult for some of these aggregators to take that step one day.
It's interesting. I wonder how the brokerage industry is going to consolidate too. It seems like you've got a couple of broker dealers that are publicly traded, right, on the independent side, but the rest of them that are sizable are private equity backed, and they're doing a lot of acquisitions too themselves. It seems like everybody's wanting to acquire, even on the brokerage institutional side. Then you've got really just a handful now of the old traditional wirehouse type firms out there. And so anyway, it's just an interesting thing. I think there's a lot to be seen over the next 5 to 10 years that will tell the story, of this business and what financial advisory business looks like then. Let's switch gears a little bit about a big topic in our industry as well as, investing in general, which is AI. Jim has done a lot of research on it from an investment standpoint, but what do you guys see in terms of how AI potentially could impact this industry?
Yeah, I mean, that's a good question. I think as a journalist, you're kind of a professional skeptic. And I think when it comes to AI, the gut reaction I have sometimes is, okay, just prove it. I think that when it comes to actual applications, I think that actually, on a view how it can help with my own job is that it can help with the back office tasks and help simplify and streamline those things. But what ultimately makes my job useful, or what makes an advisor job useful, is the power of the relationships that you build, whether it's with a client or with a source. And I don't think that AI can necessarily build trust, but I think that, yeah, maybe you can use AI to generate some sort of mass prospecting campaign. It can generate a potential prospect list for you. Maybe it can do that, or it can help with some of the trading and rebalancing. But it's very difficult for me to see AI replace what I think is the ultimate job of a financial advisor, is to have the emotional intelligence to protect a smart person from their own worst instincts and to help them. I don't think AI can necessarily replace the power of that human element.
Yes, I think that's an important point to remember. And there are some other concerns around the underlying technology we saw with the DeepSeek situation, as well as just the electricity needed to power all of this AI. At the same time, I am impressed with how some advisors out there who are using it in really interesting ways in their practices. Maybe some of the audience has heard of Cognicore. They have a really interesting digital assistant. They received some backing from Microsoft, where advisors can use this to not only help arrange a client meeting and take that whole emailing thing kind of off their plate, but also have it listen in and summarize the meeting, make the key points. The clients come away from the meeting with basically a receipt of everything that's talked about. It comes up with action items for both the advisors and clients to use down the line. And it just makes for a time-saving method. Other things out there from a tax planning perspective, we talked about how taxes are becoming more important to financial planning overall. In terms of culling through, highly sophisticated and complicated tax regulations, I see law firms, CPAs, using AI to cull through all kinds of documents at the state, federal, local level, even to come up with the answer to the client's questions and creating their own libraries that way. They're not just sitting there using, Chat GPT and asking it for, 10 or 15 suggestions. They're using sophisticated and customized tools that, take things off their plate and help them do services a little bit faster. I think I do agree. I have a little bias there as a journalist. I don't want to be replaced by a computer either, but they don't have that same humanity that people look for when they go to a financial advisor.
It's interesting that you talked about some of the different areas that AI is already impacting the business, right? So we've implemented just recently Wealth.com for the trust and estate stuff, which is a lot of AI integrated. We're going to be implementing another firm for the tax side. So at least for like the high net worth, not too complicated, down to mass affluent people, I think in those two professional services, AI has already had made a major impact. I think it's going to end up providing a different way for a lot of people to do business in those areas. So with a lot of intermediaries like us that typically weren't introducing them as much versus just a referral. Jim is interesting. I'm going to turn this over to Jim from a CIO perspective, but he and I were on a chat this morning and he goes, we're talking about organizational structure. And he goes, this is what ChatGPT says. And then one of the other things that Jim has recently introduced is to have our investment committee meetings recorded by the three main LLM models and to see how it comes back with stuff. But Jim, what do you think in terms of AI? I know you're focused on it more from an investment standpoint, but what's your input on that?
Yeah, no, I think I agree with Ian in terms of, it's not going to replace humans. Like advisors are still going to talk to clients, but from a research standpoint, I think it's a huge lift. It's not necessarily a replacement, but I think it's a cost savings as it relates to research, as it relates to the time it takes to gather, process, and analyze data. I think, Toby, you're in the financial planning side, for advisors that are doing financial plans to gather the tax documents, the financial plan documents, to go through the risk tolerance, the investments. I think I think we could deliver, as advisors, we could deliver a much better product to clients, and to do so at a lower cost. So I'm fascinated. I told Jimmy before that I want to be able to plug some of these in our investment committee meetings and do it in real time. We're not there yet, so I've been spending some time researching Claude, Grok, and ChatGPT, to be able to listen and grab and aggregate data and summarize it and give us like real time intel. I think that's where we're going, and we're not there yet, but like there are workarounds currently to do that. And I think that as these models get better at listening and responding in real time, there's a lot of information that we can leverage. So I'm curious. I'm curious as it relates to the AI question, but also Jimmy mentioned our acquisitions, M&A. That might be something that is used there too, and looking at the competitive landscape and analyzing that and like identifying which RA firms might be a good buying prospect. So.
Well, I know that's being used to scour the EDVs out there, right, Ian? I mean, I think you guys even do that in the journalism side to search for companies.
Yeah, I mean, that is a potential application. There are some people, I think Alan Darby, if you know him, investment banker, I think has been working on some AI tools around M&A. And yeah, I mean, we talk about what like generative AI or LLMs do best. They're really good at scraping large pools of data. And I think the universe of ADV filings is the perfect candidate for something like that. So yeah, it makes sense that you could build some sort of M&A prospecting tool where you can put a couple of inputs, location, AUM size, ownership structure, and it could spit out some prospects. That's an absolutely a use case for sure.
So guys, obviously the market's making some big news lately. We had an official close, like a correction last week for a moment there, a day. But besides market-related stuff, what are the big things, like trends or things that you guys are thinking about or talking about in journalism and the financial media? Like what's interesting these days?
Toby, you want to take first crack? Because I've got something in mind, but I want to give you the first shot.
Well, I mean, I'm interested in any number of things. I've got about 20 plus stories in the works right now. I think the service menu is a continually interesting area to cover. I kind of lead our coverage at the intersection of tax and wealth management. So there have been so many developments there, and more advisors embracing tax-related services of many different kinds. And, at the same time, just anything relating to practice management, financial planning. We want to be a place where advisors can come and find all of the practice management questions that are shaping the profession today. We talked about growth. One of our big stories last year was looking at the issue of growth and what tests that poses to the fiduciary duty. And there are a lot of interesting decision points that come up for an advisor as they're thinking about the future of their practice. They want to grow, but they don't want to lose that obligation, that duty to their clients. And that can go in any number of directions. It could involve using different types of fee models. It relates to the question of, do I still want to be a sole practitioner, or do I need to be in a larger company, a larger enterprise today? Is it still possible to be a successful advisor on your own in this time of massive changes to technology and a lot of consolidation across the industry? So those are just a few of the things that I'm working on right now. But there's always something else. There's always something that's interesting about this industry because money relates to everything.
Both of you guys cover different channels. So do you guys both see a little bit more of the innovation? Like, for example, I think the reason why more advisors are embracing tax planning is because if they're a registered rep and they're with a brokerage firm, you couldn't do that. right? Before the broker dealers would approve that as either something you could do as a part of financial planning or outside business. So do you guys see more innovation coming from like the independent RIA space, or is it all across the board?
Well, yeah. I mean, among the independent RIAs, everyone from the aggregators who are launching tax-related businesses and making M&A deals so that they can launch them, down to the sole practitioners who are thinking more about the fact that it's what you keep, it's not what you earn aspect of wealth building. So there are all kinds of different applications, and when you have the creative plannings of the world buying up other professional services firms that allow them to launch a specific service line for business owners, I think you're going to see more and more of it. LPL is always rolling out tax related services that they provide from the corporate office to take some things off the advisor's plates and add to the capabilities, because in terms of things being commodified in the new era, and all the experts tell me that investment management has been commodified and is growing more so, and just managing the portfolio comes down to just managing the portfolio if you're not keeping the after-tax impact in mind.
Ian, what's your take on that?
No, I mean, I think, you was asking kind of about innovation.
Yeah.
I think that innovation is kind of the product of necessity. And the first thing that came to mind as you were talking about it was just the idea, like, I was thinking back to the creative planning Goldman Sachs personal financial management transaction. And we think about how many people started new practices in the wake of that. Think about how many practices launched in the wake of the financial crisis. And I do wonder, like, the innovation we're talking about, that stuff that's our exogenous events that are kind of trickling into the wealth business. I think to see real creativity come from this industry, there has to be some, I'm not cheering for a financial crisis or something, but there has to be some sort of event where I think advisors have to react instantly and innovate in the face of necessity. And, maybe if there is we talk about there's market correction. If there is a prolonged market downturn, maybe that is something that could cause, more innovation. So that's just me spitballing a little bit.
So hey, can I ask a follow-on to that, Jimmy? So,
yeah, of course.
Jimmy and I are actually both out in Texas last week. There was a conference out there, and heard Michael Kitches speaking about some different topics, and I always, when I think of him, I think of the great job that he's done with putting together this chart of all the different pieces of technology, the tech stack, I think is what we call it. As it relates to innovation, I feel like in some ways the financial services has been kind of off on an island, kind of doing our own thing. It's different than some of the other sectors that are out there that are using technology. Do you think that we'll see innovation that's kind of within that space that can consolidate some of those little pieces? I feel like it's sometimes like a jigsaw puzzle putting all those pieces together, but curious what your thoughts are on it.
No, that's a good question. I mean, I think, Toby, you handle some of the tech stuff a little bit better than me, but I think what I would add before throwing it over to him is just, we've been waiting to see kind of a one tech stack to rule them all, right? And we haven't necessarily seen it. And I do wonder, even with technology, just because so many advisors have, I think, sometimes esoteric needs, if they're working with a unique client niche, they have specific planning needs, that I don't know if there really is one type of financial planning software that can handle everything that you need, or one type of trading software. And so I do wonder if there is an upper bound to how much of an all-in-one we can get before it becomes too generalized for certain types of advisors.
Interesting.
Yeah, there's a lot of healthy competition there. There's a lot of customer loyalty among some advisors. We saw the Schwab TD deal and the sheer length of time that it took for that full transition. And there was, quite a bit of frustration at certain points among advisors who had to change platforms. So there is a bit of just a bit of, I don't want to change this system that I've always used, in part because some of these systems are a little bit difficult to use and you don't want to learn another one after all these years. So, I understand that. I agree with Ian. It's difficult to see how someone becomes the one provider to everyone. In fact, I think it's going the opposite direction. We see startup disruptors in the custodial areas. There are always new fintech firms coming up at any stage of the wealth management process. And there are advisors who have problems that need solving on behalf of their clients. So I think you're going to continue to see that ecosystem that is a headache to just try to consider conceptually, as Kitsis does on the tech map illustration, because it is a complicated process. So there's some friendly, healthy competition out there, and plenty of grounds for innovation, because sometimes I do see some of the advisor desktops that are in use out there, and I'm just surprised because I'm no tech expert, but they look like they're from the 80s or the 90s or something. And, that was decades ago. So there's ample room for competition there.
Ian, you never answered that question. Let's turn it to you in terms of the stories that you're covering or you're wanting to cover, as kind of trending things, or what's going on in your world.
So for me, I kind of view, I think that the bull run that we've had has, I think, papered over a lot of operational weakness and poor flows in a lot of these firms that I think have tried to acquire their way out of it. I think the issue with that is that you lay on turn after turn of leverage. And so I kind of view this industry I almost call like an age of decadence, kind of like talk like Hunter S. Thompson in the 70s, where you have all these firms that are acting like they're business geniuses and look at how great our flows are, look at our margins, and it's all being propped up by the bull run that we've had. And I do think we've seen a lot of these mega private equity backed aggregators in the high single digits, sometimes even low double digits in terms of their net leverage ratios. And before I started covering the wealth business, I was writing about bankruptcy, and usually seeing a firm at 10 or 11x levered was kind of an oil and gas producer in the Permian Basin about to go bankrupt. And so I do think, you look at what happened the last time that this industry went through, in my time, starting in 2018, anything resembling like serious market stress. And that was COVID. And that was the January, February 22 pullback kind of tied to the Ukraine war. And what we saw in 22 was we saw a bunch of firms take out these preferred equity deals that had these PIK coupons. So, giving additional equity to their investors, preferred equity, at a mid-teens coupon, which again is a strategy that some distressed companies would use. And then a lot of firms in 2020 needed to take out PPP loans despite having multiple rounds of institutional backing. And so the fear that I have is that if there is a real market pullback, some of these firms that are over-levered might blow up. We might have someone trip a debt covenant. We might have want to have these things break up. And I think that something like that might cause the M&A party to come to a very abrupt halt. Someone's going to pull the needle off the record player.
That's an interesting look. I know you love covering that side of this industry. And I didn't realize there could be firms that were levered that high. 10 to 11, did you say?
There was one firm, I'm not going to name directly, but there was one firm that was at 10.7x at the end of 21, just before things went south.
I don't think Jim would like to invest on that one. That's a high level.
No.
Well, guys, I know I want to switch gears a little bit and let the viewers and listeners learn more about you guys. They read a lot of your articles. Okay. I think, first of all, the financial journalism and your industry is it's been phenomenal over the last decade, watching it grow, firms like Citywire. I don't know when Citywire was founded, Ian, for this part of the channel that you guys are in. How long ago was it?
So Citywire's been around since about 1997. We're based in the UK.
UK, yeah.
We first came to the US in 2015 with our professional buyer publication. And then the RA website started in the fall of 2018, about 6 months after I joined the company.
Okay. So relatively new, like I said, last decade in the US covering the space. And I just think that the amount of information now that financial advisors have access to about the industry in general, if you're interested, is there. And it's phenomenal, I think, that you guys do the jobs that you do and host great conferences for people like us to attend and network and meet people and learn and stuff like that. I wanted to switch gears to talk more about you guys. I know Ian's a really good poker player. So for those of you that don't know, he probably can count numbers pretty quickly. And I know he has some other hobbies, but what are you guys into for when you're not doing financial journalism, Ian? Let's talk a little bit about that. Besides poker, what else do I not know?
Well, I text you about college basketball pretty frequently. I have my teams. Most of them have been bad recently. New York Giants, very bad decade plus. Penn Quakers, very bad year. Just fired their coach, just like your alma mater just fired their coach too.
Yes.
I love running, poker, like you mentioned. I have a big sports card collection. I love reading history. My wife might say I read too much nonfiction sometimes. I should probably start buying more novels. So yeah, that's a little bit of what I'm into.
Yeah, you're an interesting guy. You know a lot about sports. I know that. We've had a lot of conversations around all sports, but is baseball your favorite sport?
Football won, and then baseball, college basketball probably tied for a very close second.
Are you gonna
interesting.
Are you coming out for March Madness?
I'm coming out for the Final Four, actually. I need to text you.
Okay.
Nice. So you got your bracket all filled out? It's ready to go.
Yeah, in a couple days.
Couple days, get it ready.
Toby, you recently moved to Chicago in the last few years, didn't you?
I did, yes. I moved here about a year and a half ago from New York, and it's been a great move. It's an awesome place to live. Sure, a little cold, but you get through that, and the summer is unbelievable. Outside of work, it's funny how similar we are because, of course, I'm a huge sports fan. Baseball is my favorite sport, and I did fill out my brackets this year. I used all the picks came from net rankings, so I made the most boring bracket of all time, just based on other teams' records against good teams and all of the formulas there. So we'll see how that goes. I don't think I'll be very successful in that. In terms of other hobbies, also a sports card collector. Also enjoy running by the lake, and very big into softball. The season's going to be starting up here soon. It takes a while for the season to get underway in Chicago because you don't want to be out there in negative temperatures. But yes, I also like to read a lot of fiction about money and about crime. There's actually quite a bit out there. I just read a really great historical novel called Sinners in the Starlight City. It's set in the Chicago World's Fair of 1933, and it involves one of the fair performers who has an axe to grind based on her family with one of the others, and there's a lot of organized crime involvement too. It was a really fun read. So, I try to make sure I get away from work when I'm away from work, but it's difficult because, like I said, everything ties back to money at some point.
Toby, when I retire someday from this business, I want to be a producer in the movie or TV industry. So maybe you can write like the next Billions TV series or something like that.
That would be great. Billions was a great series. I think it's still going. I haven't really seen the last few seasons as long. The first 3, 4, 5 seasons I thought were very, very good. Then I thought it kind of jumped the shark, as we say, about shows. But yeah, that is a great show. I'd love to. That if I could write that TV script, then I wouldn't have to write so many wealth management stories.
Hey, so I want to stay with you for a second about financial planning industry in general. You write a lot of articles around just financial planning in general, I think. And so, if you're talking to financial advisors, and telling us what you think we need to pay attention to, or changes that we should make, just things that you would put on the top of our radars, what are the few things that you may want to let us know about?
Well, we definitely talked about succession planning, and I think it's extremely important for advisors to be thinking about that well in advance of when they might be retiring. I know it's difficult sometimes to identify a potential successor, and there are all kinds of different dynamics that go into that. You don't want to be in a situation where you're introducing your clients to someone who's going to take over their account like next week, next month, or even next year. You would hope that is someone that they've come to know over the years. So I think that is definitely important. And we see all too many studies saying, a quarter or more of advisors expecting to retire over the next decade don't have a succession plan in place. But I think they've probably heard about that one a lot. I mean, in terms of the next generation, I can't emphasize enough how important that is. We hear a lot of talk right now about volatility and the larger economy. I remember when I was entering the workforce around 2008, that was not an ideal time to enter the workforce. So for me, it is refreshing to be able to write all of these stories about an industry, a profession, a rewarding profession where they're looking to hire people. They want young people and career changers to come into the profession. And there's still some high barriers to entry in terms of getting that next generation set up to succeed in a challenging competitive field. So the advisors who are innovating in this area really have a distinct advantage. And I would urge all the independent advisory practices out there to be thinking about how are we setting up our interns so that they can enter into a career path, be paired up with one advisor or another, fit into specialized roles in a team, and find their place in an industry where you're helping people and you make a rewarding living. So you don't hear too much about that these days when you have people looking for work and they don't know what field to go into and they want to learn more skills. Here in wealth management, they're looking for people, and it is difficult because it takes training, it takes a lot of human, soft power skills that advisors have, and those take time to develop. So it's a tricky situation, but there's a lot of potential for future success there.
It's we do have such an amazing industry. It's such a rewarding profession where we can do well professionally from a career standpoint, but also give a lot back to the people that we work with. And there's a lot. So when I got into business in the 90s, you were either a financial advisor or a sales assistant. And if you're managing money, you're working for some large firm. Nowadays with all these firms out there, you got CIOs like Jim and his team working at smaller firms, even though we're decent size like us. You don't have to be with a big Wall Street firm like that and have lots of different jobs. And I've also seen recently when we put out an ad for a financial planning type role, not business development role, we have a lot of females that apply for those jobs, which is phenomenal. The financial advising career, in my opinion, is especially unique for a working mother or a working father, somebody that's staying at home and having to work at home because of I was doing work from home before COVID, and now everybody's working from home, and clients actually enjoy it too. Only a smaller segment of clients actually want to drive to an office, especially if you live in like a Chicago or New York City or LA. Maybe if you're in a suburb and you want to drive down the street to your advisor's office once in a while. But anyway, I think it's such a wonderful profession. And so I would say to you, though, don't stop covering succession planning, you guys, because as much as we hear about it, the percentage of advisors that actually have solid plans, it's not a high percentage, I'll tell you. I can just tell you from experience, we've had 2 deaths among our affiliated advisors in the last couple of years, and one was sudden and one was not. But in both scenarios, it wasn't necessarily smooth, even though one of them had a plan. And so also, I think from a financial perspective, for many financial advisors, their business could be the most valuable asset that they have. And on a sudden death situation or permanent disability could discount the value of their largest asset by more than 50% overnight. And so even though we're planners, I'm not sure necessarily the old adage goes, we look at our stuff last. And people really need to pay attention to that. Ian, when it comes to the things that you're seeing in the industry, I know you talk a lot about what firms are doing, different, momentous type news that's going on with mergers, or different people that are big names in the industry. What do you see? What's going to be the newsworthy stuff you think that's going to be happening in the next couple of years?
Yeah, I think I would reiterate the idea of the consolidation. I think for the first shoe to drop will be one, whether someone files for an IPO, files an S1 to go public. I think the second is, when is the first mover in terms of the merger of strategics? I also wonder, we talk about kind of early career advisors. I do wonder, the prior presidential administration moved really aggressively on non-competes, especially for early career workers. I think one thing that we've seen with some of these deals, like we talked a little bit about what happened with the advisor retention and the Goldman Creative transaction, is that there's a lot of litigation now between firms in the fight for talent when advisors leave. And so I do wonder, given the current regulatory regime, are we going to get an answer in terms of who really does own the client relationship? Is it the advisor or is it the firm? And I do think we're going to see a lot of stuff. I see Tobias, like Toby, just shaking his head with this. I think that the legal drama we're going to see over the fight to keep client relationships. Look, you have LPL and Ameriprise going at each other, creatives involved in stuff, Allworth, Mariner, Savvy. The war for talent, I think, between RAs has escalated significantly. And that's also downstream of this professionalization, because it used to be that, flow of talent was generally unidirectional, right? It would be people leaving the wires or the insurance IBDs or the hybrids to go totally solo. And now RAs are picking off RAs for talent. And I think the ramifications of the war for talent are going to echo through the next couple of years. And that's going to be a big theme.
So I've got 2 quick questions for both of you and see what your opinions on it. They're big subjects in our industry. And then maybe Jim's got something before you end. But what do you think about the whole 1% fee thing? We've been hearing about margin compression for years. And just from experience, again, I know that good advisors have not had to lower fees for the value they create. In fact, as we've discussed, more advisors are adding more services for the same fee. What do you think? Are we going to wake up someday? And by the way, when we talk about AI, I am going to buy, I'm committed to it now because I've talked about it so much. I'm going to buy a humanoid and see if we could train it to be an actual advisor and see what happens. I think you can buy one for around 20 grand these days. I'm sure it'll be a lot less in the future. But I've been saying to people, I wouldn't be surprised, and we've been talking about this, if we wake up one day and Amazon's bought a whole bunch of firms and a custodian, and all of a sudden they try to really dominate the space through margin compression. What's your guys' opinion on that?
So I view the 1% fee, I think that it's a matter of framing. If you're framing the 1% as you're paying that 1% to hire a stock picker that can outperform the markets, I don't necessarily think that that's sustainable. But I think if you're talking about the 1% fee in terms of, one, access to kind of the family office type services, complex planning, tax prep. There are firms like Pathstone where they'll help you get private security and a private jet, like the concierge level services. So I think that, and also we think about it just from kind of, we talked about playing poker, like game theory stuff. You're paying that 1% to avoid risk of ruin, basically. Because a lot of these people, doctors, lawyers, there's some that can do this stuff self-direct, on a self-directed basis, a lot of them either don't have the time or aren't fully trained up and able to do it. And so you're framing it as you're not paying 1% to beat the market, but you're paying 1% to mitigate and almost eliminate the risk that you're going to lose everything from you trying to do it by yourself. Well, then I think you could justify not only keeping it at 1%, some people could argue, you could argue for fee expansion. So that's how I'm thinking about it.
Yeah, I think sometimes the either or aspect of it gets a little bit overhyped, where the data shows that most RIAs are using several different types of fees, but I think client demand is really going to change a lot over time, where you have older, more high net worth clients who are comfortable with 1% or even less if they have, the possibility, the need for private jet or private security. But the industry needs to expand its client base. That's what McKinsey was talking about and warning that there is going to be a shortage of 100,000 financial advisors within the decade based on the demand there. And, these younger clients are, to our earlier points, going to be used to new technology that is, much more just taken for granted these days and even expected. And they're going to be more interested in something like a subscription fee, a flat fee. We see a lot of advisors innovating, and they're saying that they can serve a wider base of clients who go beyond the industry's traditional base of the wealthy and ultra wealthy, where we know the mass affluent, the affluent, and everyone could benefit from qualified, credible advice. And at Financial Planning, we started all the way back in 1974. We were part of the original, the forerunner to today's Financial Planning Association. It's a little known fact. We split off around 2000.
This is news to me.
In other words, ancient history, 25 years ago. But anyway, one of the things that we're always tracking is retainer fees, flat fees, and advisors who embrace them. There is a discussion among some planners about how the fee models and conflicts of interest come into contact, where they want to make sure the clients know that they're paying a fee for financial planning specifically. They're not paying for investment management. The advisor doesn't worry about which platform is holding which assets. The advisor is giving you a flat fee service. And there are some clients out there who are going to see more appeal in that, where they say, I want to just come to you every few years and have you make out a big financial plan for me, and I'll stick to that myself. And, they want to work with you in whatever capacity they want to work with you. So are advisors set up for that future? Are they taking part in a very high-minded and important debate? Sometimes it can get a little bit ugly in terms of, some advisors accusing others of not truly living up to the fiduciary duty. But that's the sign of a healthy profession, where you have innovators and you have important questions being asked all the time. Ultimately, it's a marketplace of ideas and a marketplace of clients. So they're going to be the ones who determine the future there. But there is a huge challenge facing this industry when you need to hire 100,000 advisors over the next decade or else.
Well, that's amazing. That's great insight, guys. I remember Ian and I spoke 7 or 8 years ago when we rolled out what we call our Henry model, high earner, not rich yet, right? Model. Subscription-based monthly financial planning fees. And it's been very successful. And, I've listened to podcasts on Kitsy's and other ones where there's financial advising firms that have lines waiting, for them to get in the door of these firms that are just charging flat fees for advice and not necessarily for the portfolio management side. But they offer that similar service. So I think you're right. I think a lot of different models will evolve for different segments of clients that want different types of relationships, right? So that's what's neat is that's innovation, and that's happening. I go back to the IAFP days. I was a member. I'm not a CFP, so I wasn't in part of that. But anyway, so that's awesome. Jim, do you have anything that you would like to add before?
Yeah, I just had one more question, really, because you mentioned Toby, fiduciary, and I feel like the focus on advisors doing the right thing and innovation feels like that kind of goes hand in hand. I started back in the business back in the late '90s, and I feel like there was a few more bad apples, and I feel like over time, advisors have just gotten better and better and better. I don't know if that's because the bad ones, they got caught or they just got disrupted, but I'm curious what your thoughts are going forward. It feels like there's more transparency, feels like it's better for clients, that we truly are acting in the best interest of clients, but just want to hear both of your thoughts on that.
Well, it's a continual discussion and around whether these are professional ethics alone or whether there needs to be more regulation. We saw the Biden administration try to pass its version of a fiduciary rule that would have expanded the duty to more areas in serving retirement savers, and that got defeated by the industry, and the Trump administration is not likely to pursue any appeals of that. So at this point, the regulatory side on a federal level is kind of gone. But there are still questions on a state-by-state basis. We talked about fee innovations. That's one of the challenges around fees, is that a lot of state regulators still in 2025 are skeptical of this arrangement of a flat fee and a retainer fee, and they're a lot sometimes tougher on advisors who are using that because they want to be shown that they are performing a service. But apart from all of that, I mean, there are still a continuing and disturbing flow of fraud cases year after year. The SEC uncovers billions of dollars in fraud. A lot of experts say it's multiples of that based on the amount that's unreported. Elder fraud is just a horrible thing. A lot of times the victims don't even want to come forward because they're so ashamed about it. There are all these bigger issues that get tied into money, where sometimes people are even afraid to work with a financial services firm just based on the history of money in this country. So, it's difficult to say where that dividing line is going to be over time, considering there are still some regulatory questions and there's a lot of robust, we'll call it, discussion around the industry as to who is putting that in motion.
Sure.
So it's changing all the time, but I agree it is getting better for the clients when you see those fees going down over time, and you see more clients asking their advisor, "Are you a fiduciary?" How does that work?
Yeah, and I think just to add on to that, I think sometimes the discussion of the fiduciary branding identity, I think is something that's more of an internal thing than an external thing. I think that kind of at the end of the day, people win clients not based on the label attached to them or even the place that they work. It's based on trust and a deeply personal relationship. Sometimes that's a good thing. Sometimes that's a bad thing when you see people work with advisors who have been caught doing bad things, but they won't believe it. I mean, like I know someone in my family who got churned by their broker for years and years and years. And they still gave him a tie at around Hanukkah every year because they liked the guy, even while they were actively just because of the relationship with them.
Wow.
And so, yeah, I mean, not to get too real there, but like you see some of this stuff, like this is a trust-based business, and I think even with some of the potential regulatory setbacks that the fiduciary rule gets, if you're an advisor who can cultivate trust for your clients, you're going to keep winning them, no matter what the wires or other types of shop, how they try to market.
What a great way to end the podcast, guys. I'm on my last 2 sips of this green smoothie too for St. Patty's Day. Ian, we hope you have a blast there. We hope you have some killer interviews. I'll be watching out for your articles and interviews. And Toby, same. I see Ian more than you. One of these days, we need to catch up somewhere. And but guys, thank you so much for participating. I really do believe that what you guys do is important for this industry. And it helps firms, and I think keeps us informed, but also in check with a lot of things that are going on. And it's great for clients, investors. And so thank you very much for what you guys do. Keep it up. You guys don't get paid enough for what you do. And so make sure that when you're hanging around with people like us, we're buying the drinks and the hamburgers, okay? Cheers, guys. Happy
Thank you so much.
Come and dance on our floor. Take a step that is new.